Maya was 27, landing her first apartment, financing a used car, and juggling 2 credit cards. She thought she was on top of her money, but when she sat down and actually crunched her loan statements, she realized she had paid over $4,000 in interest and fees she never fully understood. The culprit? A 3-letter number she had been ignoring her entire adult life: APR. Today, we're going to break down exactly what APR is, how it differs from a basic interest rate, and how understanding it can save you thousands of dollars over your lifetime. Here's where most people get tripped up, and where Maya definitely did. A lender might advertise a 5% interest rate on a car loan, and that sounds reasonable. But the APR, the annual percentage rate, is almost always higher. That's because APR includes not just the interest, but also origination fees. The Truth in Lending Act actually requires lenders to disclose APR, precisely so borrowers like Maya can make a fair comparison. Now let's get into how APR actually affects your day-to-day life, because this is where Maya got hurt the most. The average credit card APR in the US is currently around 21%, according to Federal Reserve data. Here's how the math works. Your credit card company takes that 21% annual rate and divides it by 365 to get a daily rate, about 0.057% per day. If you carry a $3,000 balance, you're being charged roughly $1.70 every single day you don't pay it off. That adds up fast. Maya had been carrying a balance on one card for 18 months. She never realized how much she was bleeding in daily interest until she saw the total. Let's put this in perspective visually. This chart compares average APRs across different types of borrowing. See how credit cards sit at the top, dramatically higher than auto loans or mortgages? This is why carrying a credit card balance is one of the most expensive financial mistakes Americans make. A 30-year mortgage historically averages around 7%. Auto loans sit around 8 to 10%. But credit cards? They can hit 25% or higher for borrowers with lower credit scores. This is exactly the comparison that changed how Maya thought about her debt. She realized she needed to attack her highest APR balance first, immediately. Here's the number that finally made Maya stop and recalculate everything. If you carry a $5,000 credit card balance and only make minimum payments at a 21% APR, you'll pay approximately $2,835 in interest over 3 years, on top of repaying the original $5,000. That means you're paying back almost $8,000 total for something that cost $5,000. And that's not an edge case. That's the average American experience with credit card debt. The math is brutal when you see it laid out like this. This is for educational purposes only, but the numbers speak for themselves. There's another layer Maya didn't fully understand, and it's the difference between fixed and variable APR. A fixed APR stays the same for the life of the loan. A variable APR fluctuates based on a benchmark rate, usually the federal funds rate set by the Federal Reserve. Most credit cards carry variable APRs, so when the Fed raised interest rates aggressively between 2022 and 2024, credit card APRs climbed right along with them, often by several percentage points. Maya's card APR had actually gone up twice without her noticing, because she'd stopped reading her statements carefully. If your APR is variable, rising interest rates directly increase what you owe. This is the chart that connects the dots between Federal Reserve policy and your credit card bill. This shows the federal funds rate over the past several years. Notice the dramatic rise starting in 2022. The Fed raised rates 11 times to fight inflation. Because most credit cards have variable APRs tied to this benchmark, average credit card rates surged from around 15% in early 2022 to over 21% by 2024. For someone like Maya, carrying a $5,000 balance, that shift alone added hundreds of extra dollars in annual interest. Understanding this connection is crucial for managing your debt strategically. APR matters just as much on big purchases. When Maya eventually bought a car, she almost signed with the dealership's in-house financing, a 9.8% APR. But she took one afternoon to shop around and found a credit union offering 6.9% APR on the same loan.
On a $25,000 auto loan over 5 years, that difference saved her roughly $1,900. On a mortgage, the stakes are even higher. A 0.5% difference in APR on a $300,000 30-year mortgage translates to over $30,000 in additional interest over the life of the loan. Always compare APR across multiple lenders before you sign anything. The advertised rate and the APR can tell very different stories.
So what did Maya actually do once she understood all of this? Here are 5 strategies she used, and ones you can start today. First, she stopped making minimum payments and started paying as much as she could afford each month, attacking interest at the source. Second, she transferred her highest balance card to a 0% intro APR card. Many offer 12 to 21 months interest-free. Third, she actually called her existing card and negotiated a lower rate, something that works more often than people think. Fourth, she focused on raising her credit score because a better score unlocks dramatically lower APRs. And fifth, she automated her payments to avoid late fees, which can also trigger penalty APRs as high as 29.99%.
Let this number sink in. Over 30 years, simply securing a mortgage APR of 6.5% instead of 7% on a $300,000 loan saves you approximately $31,200 in total interest. That's a family vacation every year for a decade, a college fund, a retirement boost. And you don't have to be a financial genius to access those savings. You just have to shop around, understand the APR you're being offered, and negotiate. Maya learned this lesson on a car loan. Imagine applying it to every major financial decision you make for the next 30 years. The compounding impact of lower APR is just as powerful as the compounding impact of investing.
Maya's story isn't unusual. It's the American average. But here's where she landed. Within 18 months of understanding APR, she had paid off her highest rate card, refinanced her auto loan to a lower APR, and saved over $2,000 that would have gone straight to interest. She didn't earn more money. She just got smarter about where her money was going. The 4 things to take away from today. APR is the true cost of borrowing. Always look at it, not just the interest rate. Compare APR across at least 3 lenders before any major loan. Attack your highest APR debt first to stop the bleeding. And work to build your credit score, because every point up can mean a lower APR offer next time. Start with one of these today, even just calling your credit card company. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any financial decisions. All interest rate figures and loan calculations shown are approximate and used for illustration. Past performance does not guarantee